Once again, I'm here together with Bruce Fraser. And Bruce, after we just discussed about all the mindset for the podcast for the first episode we had together, and we were just joking around like, okay, let's continue one day. You just said, okay, let's continue right now and discuss more about the Wyckoff method and how to be really a Wyckoffie. And I'm so happy that we have a lot of time and to go deeper into this. So welcome back again to the show, to the podcast, and also to the YouTube channel where I publish this as well.
It's so great to be here, Wieland, and it's always fun to chat with you because it's easy and it's fun. It's just I love to have these discussions. So thank you for that. But I have to say, Wieland, when we got off our podcast, which took an hour, went a whole
Yeah.
hour. We talked about mental states and all that stuff, and Wieland gets off and says, "Well, I really want to talk about Wyckoff." So
Yeah, yeah. I mean,
no,
there's no such
I'm
thing.
kidding you. I'm making fun. I'm kidding
Yeah,
you because it's
it's
like
it's
we
fun.
went completely off the rails on all this other stuff, and didn't. So I said, "Well, let's just do it now."
Yeah, I mean, so I'm really happy that you have reserved some more time. And actually, we started earlier than we just
Yeah.
agreed on, so we have some time left. And yes, that's why I don't have like prepared questions 1 to 10. And I just want to go with the flow, which is
Oh, that
perfect
last
and natural
conversation
and
was
more
so much
fun,
fun. Yeah,
right?
that last conversation was a blast. So,
Yeah.
and so thank you for that. But the second best thing to talk about is Wyckoff.
So
So
let's
I'm all
let's
for it.
go into this. So what is Wyckoff about?
Well, Richard D. Wyckoff he was a person that came into Wall Street. He grew up in New Jersey, and he he came into Wall Street as a young man. He was like a teenager, and really didn't his education was maybe like a first year high school student, et cetera. And then oftentimes young people back in the 1800s didn't go all the way through school, or that was as far as school went. And so he went to Wall Street and he started to really be intrigued with some of the greats of the day, J.P. Morgan and so on. And he started to study them. And he was one of these young men that would take correspondence, and they literally would, when they bought and sold stock, they would have they would take the stock certificates from one firm to another, from the person that sold them to the person that bought them. He would do some of that. And so he was quite observant, and he started to really pay attention to what people were actually doing on Wall Street. And he started to really read the true intentions of the players. He called them the composite man, but we call them composite operators today. But these were the large interests on Wall Street that had the ability and the power to be able to drive stock prices up and down. And with the belief that he believed that the public just didn't have the ability to be able to drive prices up and down. So anyway, we basically had the public had to be able to just go along for the ride, and identify the proper moment to be in the market, identify it on the chart. He called it tape reading, and the idea of tape reading was that you could look at now the old tape reader was somebody that looked at the ticker tape with the prices that would come across it. But in fact, he looked at the charts, and he would look at the price and the volume for the day and the week, and then he would call that tape reading, bar by bar analysis, price volume analysis. And so that is what we would teach at Golden Gate University in the class. So and then what he did, he was an amazing guy. He actually started a magazine called The Ticker on Wall Street, and The Ticker was a magazine that was devoted to Wall Street trading. And he literally taught himself how to be a good writer to write the ticker, because he wrote much of the content in it. And that is how he became a great writer. And then also what he would do is he would write these concepts of the financial markets and what was going on in his magazine. And that magazine became quite successful, and kind of a predecessor to maybe a magazine like Barron's is today. And so in many of his articles that were written in the ticker were subsequently put into books. And so these articles are, these collection of articles are in some of the books that are under his name. So what we're seeing here is just an example of the process of accumulation. And this is not really, I would describe it as not being necessarily pattern recognition. It's more behavioral recognition. It's being able to see the characteristics of price in a downtrend, understanding how price behaves in a downtrend, how price behaves in what's an accumulation structure. And the reason, so what he would characterize as happening here during accumulation is that stock would go from weak hands. He would say the reason that you get big downtrends in the market is because stock is in weak hands. And the composite operator has no desire, interest, or attention in pushing prices higher because they own a lot of the stock. They don't own the stock, they're out. And so the public or the weak hands own these stocks, and they're able to fall. And they go into a value zone, this zone that the CO types say, okay, I'm going to start to accumulate these shares. And that's typically characterized by this event called the selling climax. And the selling climax is just a big whoosh down. It's literally just a giving up of prices at the end of a decline, and a panic. It's effectively a panic. And then after that, you get a sharp reversal that is much greater than the reversals that preceded it in the downtrend. And that's called an automatic rally. And here's the beauty of these two events is if you properly identify them on the chart, the selling climax becomes an essential support zone for the stock for the foreseeable future, and the automatic rally becomes the resistance zone. And even though the stock or the index or the commodity can bound out of those zones, like through them, they will reverse back into them in short order and stay in here, because what is happening is that you actually have the effect of accumulation taking place, where the composite operator types are using the bottom of this range bound condition, this accumulation, to buy additional shares at good prices. And what happens is, and I actually have a schematic of this, is this is a stock, Shake Shack. It's a restaurant. You can see here, here's the downtrend taking place, and a selling climax occurs here, which is actually occurs over a number of days. Then a very sharp advance, and the sharp advance immediately pauses and reverses back in to the structure. So you have a selling climax, automatic rally. We automatically draw support and we draw resistance, and we see that the instrument trades in that zone for the foreseeable future, and it spends a lot of time in the bottom part of the range. Traders hate this. It's very discouraging to them. And so stock, I try to visualize this, goes from weak hands as the traders give up on ownership. They owned it at higher prices. They maybe got into a loss trap, and they are now selling their stock just because they're worn out. They're tired of owning it. Meanwhile, the composite operator types see nothing but value in this instrument, and they are buying in the bottom part of the range systematically, persistently over a long period of time, because the composite operator needs a long time to accumulate enough shares because they buy so many of them. And then the stock goes from weak hands to strong hands. And when the stock is sufficiently in strong hands, the public is out. And the characteristic of strong hands is that these are institutional types, hedge fund types, but the have the characteristic of composite operator. They will hold this stock. They will not sell it until it gets to much higher prices. They believe that it's going to go up. It's going to go up for a long time. It's going to create significant returns. And they effectively have locked up the shares. And this is the principle in Wyckoff of supply and demand. Supply is high over here, and demand starts to come in at these prices, and demand is absorbing all these shares until demand has sufficiently absorbed enough shares that supply becomes scarce. And when the supply is scarce, the stock can move up easily and effortlessly, even on low volume, for a very long time. So anyway, there it is. That's sort of the essence of it. And that is what we look for in the price volume analysis of these instruments, is the characteristics of stock going from weak to strong hands and from strong hands to weak hands, which is called distribution.
Yeah. Yeah. I mean, we're looking at the chart for those who cannot see this chart. I mean, you have a typical downtrend covering lower highs and lower lows, and going over to the sideways trend with at least 4 bottoms or touches of the bottom, and the same at the upper side for the bounce of the upper restriction. So looking at this, first question I have here right now in mind is, you say, yeah, traders hate it. Definitely, traders hate when the stock doesn't move so fast and far, especially if they're trend followers, obviously. But as a trader going more for reverses, I always feel like, yeah, why not buying at the downside and selling at the upside, and just going with these moves perfectly in the trading range? And that's what traders love. But it's not really like staying there forever just for a short term.
You're speaking like a true Wyckofian. So see, there comes a moment, and this is what becomes a real top skill of Wyckofians, is that where you see the characteristic of the way the stock is trading change. And note here, when this broke off of this level, that the volume was quite high. It went up to the resistance zone and reversed on very high volume and wide range. And like that is a demonstration of supply.
Yeah.
And supply comes in, and it shows that there's still a lot of weak holders. And as you get towards the bottom of the range, the volume, especially on the down days, is drying up. So this is a good sign that absorption is occurring, especially in the bottom part of the range. But the institutions, the CO types, are saying, there's still a lot of supply in this market. And you see that over here in this bar right there.
Yeah.
And then you come over here and you see that it doesn't get up to the resistance zone, which in and of itself is a bit of a warning, because it doesn't have the demand yet to get up there. And so it turns off of this, but look what happens. The volume doesn't appreciably widen as it turns back down, which is demonstration of the fact that supply is in an advanced state of being absorbed. And so these are the things that Wyckoff would look for. And so here you can see a very wide ranging bar and very high volume. This bar goes down to support, but it really does no damage because the supply doesn't take out the support zone.
Yeah.
And the volume comes in on the bar that takes it back down to the low part of the range. This is a good value zone for the CO types to be buying in. So we would conclude that the volume here has good demand in it. And confirmation of that comes on these next bars where spread narrows appreciably as it goes to support and the volume really dries up. This demonstrates that supply is largely been absorbed. So those are the characteristics, and we call these, we can eyeball this area and we can identify these key junctures, and we give them phases. We define them as phases. Phase C is the last testing phase in an accumulation. And then phase D is the rally up to the top of the range. And notice something very unique and different happens up here. First of all, volume expands off the lows here, very bullish. And it becomes quite high on these two big high range days that exceed the resistance zone for the first time since the automatic rally. This we call a sign of strength, but sign of strengths often result in a reaction back into the accumulation area. But note that it reverses at the midpoint of the range and starts to go back up again. So we are on the alert because of how well, look at the character of this rally versus all the ones that preceded. Much better, much better. So we may have, Wyckoff would buy in tranches. So he'd buy a tranche here, and typically he thinks in threes. So first tranche here, you never buy a second tranche unless you have a profit in the first. So you're always averaging up your position. And so here, these two bars come on good volume. So we might either trade these two bars or on the breakout above these two bars or the breakout of these bars. So this might be tranche number 2. This might be tranche number 3. And always averaging up our position, and then boom, off it goes. So this is the way that Wyckofians think about accumulation. It's all contextual. Phase A has different price volume behaviors than B. Phase C has different behaviors than B, and so on.
This is interesting. I already think about, okay, how to use candlesticks for this. And the thing at phase C, where I felt like, okay, this is the bottom. This is like the last time the price made a bottom before it just rocketed up. And what I see here is like 1, 2, 3 spinning tops, giving a sign of indecision where people think, should I sell? Should I buy? I don't know. Let's see what happens later. So, they just don't want to act at all. And basically, after a down move, this is also can be interpreted like a sign of a reversal, which happened also. Looking at the breakout of the resistance zone, I see this huge candlestick, which is a huge sign of strength, which you already mentioned. But then with the down move, the correction of it, I see a nice morning star building the higher low. And in combination with the last low, which already has been formed, testing the downside of the move, like testing the bottom of the range, then I have already low, high, higher, low. I would enter with the morning star. I would re-enter again with a little dip with the 2 red candles, which is like the 3 black crows, kind of like this, and you're good to go. So it's a perfect combination. I love it.
I think candlesticks are such an elegant, beautiful way to look at price data. And actually, I've always been very kind of impressed and amazed at your understanding of candlesticks. And I use them because I think that they're so visual. They're
Yeah.
such a great visual way to be able to look at price volume. But I'm just a um, classic Wyckofian who just looks at these same characteristics that you're seeing
Mhm.
in the candlestick features, and I'm
Yeah.
just seeing these great Wyckofian characteristics
Mhm.
that really show up, in my opinion, best
Yeah.
on these candlesticks. I
Yeah.
don't think there's a better visual way.
No,
And
it's a perfect match and a perfect combination. And I really love it for the simple reason that, you know, discussing with a lot of colleagues and traders, at the end turns out we are always looking at the same areas. You
exactly.
know? So,
People say, yeah, people
yeah,
tell me all the time, people that are exceptional professionals in the industry, and they go, we'll talk about Wyckoff, and they'll go, I think I use a lot of Wyckoff principles. I just call them by different names.
yeah,
And I said, well, all Wyckoff is it's just best practices.
yeah, yeah.
That's all it
So,
is. It's just best practice, and whether or not you learned it under a different set of disciplines or methods,
mhm,
or you learned it as Wyckoff, it's just the way that markets function, and it's a beautiful way. I just use Wyckoff because I was raised on it.
uh-huh,
This is how I learned to characterize and trade markets, and so
yeah,
I speak in those terms. But absolutely, it's best practices.
yeah. So it's a beautiful chart. And also you can spot like 1, 2, 3 reversal formation. You can spot everything. And yeah.
And these the thing about this is versus the schematics,
Mm,
and the reason this isn't really pattern recognition like head and shoulders and tops and bottoms and things like that, pennants and so on, is not that they're not valuable, they're very good, is that this is all behavioral characteristic.
mhm.
So you expect certain kinds of behaviors in a free falling market in price and volume. You
Yeah.
expect certain kind of behavior in a phase B trading range.
Mhm.
Phase C, Wyckofians, now we don't always get it right, but Wyckofians will get involved in a stock in phases C, D, and E. E is when the markup has already started.
Mhm.
So we will become involved once we think that the final testing is in and it's ready to start to scale higher on a long-term basis. Now,
Yeah.
these principles work in they're fractal. They work
Mhm.
in any time frame. And so some people use them intraday, others daily, others weekly. This
Yeah.
chart is a weekly chart.
Yeah. That's why it
Now,
doesn't offer any gaps, which is always nicer to see and better to analyze.
so and I do a lot of work in daily, and I do work in intraday too.
Mhm.
And but here now this is the other aspect of Wyckoff, which is the point and figure,
Mhm.
and the point and figure charts. And this is a very old. This may be the oldest form of charting there is. Supposedly, this charting goes back to the 1500s in Japan,
Mhm.
and trading commodities with point and figure. And I used to have, when I was a student for in of Dr. Prudence, I had a lot of friends that worked down on the Pacific Coast Stock Exchange. So I would go down and I would spend time with them. They would ask me to come down. They actually wanted me to become a floor trader with them, which I had thought seriously about doing. But they had these cards in their hands, and they were about the size of oversized trading cards or
Mhm.
playing cards,
Yeah.
and they were just blank grids like this grid here. And they would stand there and they would be making markets in maybe 8, 10 stocks
Mhm.
on the Pacific Coast Exchange. And they would stand there and they trade a lot of options on Silicon Valley stocks and of that era. And they would, with point figure, they could literally keep their point and figure charts while they were standing in the crowd making markets. And so I believe that's the reason why. I bet if you went back into the futures markets, the pits in Chicago, and even in prior times that they were keeping point and figure charts while they were standing there making markets. And because you can do that, you can't hand draw vertical bar charts very easily while you're standing in a pit, but you can do point and figure. And point and figure, you'll notice, is not a function of time, it's a function of volatility. This is a 3-box method. So the only thing that can get a point and figure chart to reverse from down to up or from up to down is a 3 whole point move, whatever the scaling that you have is, in the opposite direction. And volatility is what causes stock to trade hands. So volatility, the effect of volatility is stock is whipping back and forth and changing from one owner to another. And it's our job to determine whether it's going into stronger hands or weaker hands.
Yeah.
The utility of point figure is this, that, and this was a Wyckoff technique, is that Wyckoff could identify from this using a horizontal counting method. He could count these columns across and estimate how much potential there was for the stock to go up. So roughly speaking, the volatility, which demonstrated stock going from, in this case, weak hands to strong hands, translated into the potential for how far it could go up. So at the point at which this stock was done accumulating, had a low of 31, had a high of 47, and a count line at 37. And there's very specific rules for how to count point figure. And there's 2 segments that I counted here. The first one goes 70 to 76. And the second segment, which is all the way across, you count from right to left, counted up to 123 to 131. And so a very important combination to the vertical bar chart analysis, which we just did, is the point and figure analysis. And you also, a very powerful method for swing trading is the 1-box reversal method. And so here you can see these counts, and here I put on the vertical chart what actually happened. So you can see that this first count, which I have in yellow shading, this is the accumulation we just evaluated, counted 70 to 76 and went right to 70. Had a correction, came all the way back into the 40s, retested support, and then it rallied up again, didn't get quite up to these objectives, pulled back, and then finally on this, but did not go to new lows. It went down and retested these lows, and then it rallied again and went all the way up and eventually did hit these objectives that were on this accumulation structure. And so point figure analysis is, I think, a great complement to the vertical bar chart analysis.
It's an interesting idea. And I mean, it looks like you're solving the everlasting question, where do I exit? You know, where's my profit target? It's usually people go, just look to the left side, go to the recent high or recent low, but obviously there's more to do.
Well, such a good point, Wieland, because in our prior podcast, we talked about the 10 tasks of top trading. And it's mental state management. And one of them is, and of course, one of them is to understand what your edge is. And I consider my edge to be able to identify accumulation structures that can produce big uptrends, and that these uptrends can go. We can't tell how long they go, how many years, et cetera, to get to the objectives, but we can estimate how far. And what this does is it gives me patience. And so this allows me to be able to go into what we called in the 10 tasks, the monitoring phase.
Yeah.
I own it. I own 3 tranches, and I own it at an average price. And I'm looking for a price objective in this area or this area.
Mm-hmm.
And this gives me the patience to sit on a trade until I get the evidence of exhaustion of the uptrend, which demonstrates itself as distribution.
Yeah.
And so you'll see a trend go up and up and up until you see buying climactic behavior, exhaustion of the uptrend, a big automatic reaction, and a range bound condition. And these are just 2 different schematics, represent different characteristics that might show up, but distributions can take many forms. Same idea, phases, how the behavior changes from as you go through the phases and so on. And so an example of that is the 2021 bull market top. And so here is the buying climax, automatic reaction, range bound condition. And this is a daily chart, and it tested and then broke down. And then this all became a bigger part of the distribution structure and produced a big long-term downtrend. So their distribution happens a little differently than accumulation. But look at this, Wieland. Look at this accumulation.
Yeah.
Oh my gosh. This is a huge structure. And this was in 2022. This is the NASDAQ 100. And look at this climax. Gaps. Look at these big gaps into June of 22. And down it went, and then immediately reversed up into an automatic rally. Very sharp advance, but it was very short-lived, and then returned all the way back down to the lows again and continued to build cause. And then this is what has happened since.
Yeah. Yeah, this is now, I mean, we're talking midst of February 2024, where everybody's going crazy about the rally, which is never stopping. And that's basically the point. So, you have like these really rapid, sharp moves with, without any stop, any correction, any pullback, any nothing. And then looking at the chart, I feel like, okay, where could I've entered? And once again, this accumulation zone offers me a lower low, a high, a higher low, a higher high with a breakout. And already I just see it. And that's something where you can see, like, okay, how is the market talking to me? Because earlier we were discussing, okay, is the market really talking to me? Yeah, it does.
Yeah.
I just have to listen. I have to watch carefully, and also put aside all my doubts I have. Because, if a stock is down or market is down and nobody really wants it for that price, how could I really believe that this changed this time,
I have I think I have, well, we recall, maybe I don't have it in this deck, but the sentiment, here we can look at it here maybe. No, this isn't it. Well, I apologize. I don't seem to have that.
Yeah, no.
But I was going to try to find a sentiment slide. But here's the thing. Here's the thing about this is that, and here's the S&P right here, is that, we do a weekly Wyckoff market discussion, Ramon and I do. And it's at wyckoffanalytics.com for anybody that's interested. But through this whole period, these are my notes. These are actually my market notes. And so these are the determinations that we were making as we had the unfolding structure. And we were going through, and we would discuss this in our Wyckoff market discussion on Wednesdays. And each one of these lows, you could see the characteristics of oversold and divergent characteristics and where the rallies were occurring. But all of this was in the preparation phase. This is exactly what we just looked at with Shake Shack and the accumulation.
Mm-hmm.
All these characteristics are part of an accumulation, and you have to have a distribution before you get a downtrend.
Mm-hmm.
And you have to have accumulation, a preparation phase of accumulation before you get an important uptrend. Yeah. And so here you can see both of these characteristics showing up right in the S&P 500. And you're able to identify these key junctures from a Wyckofian perspective, mm-hmm. and be able to trade this accumulation, understanding that this accumulation is going to result in an uptrend. And so just to illustrate that point, I was doing point figure analysis of the S&P 500, and this is actually October of 22, and this was an important low. Look at this low, took out the climax low, mm-hmm. that occurred earlier. I was able to take little swing counts, and they projected up to the top of the range in each case. And I said at the time, this accumulation isn't done yet. It's going to rally up to the resistance zone. This is how much count we had. We traded that up to the resistance zone, but we said it's likely to build a larger count. And this is the reason I would put my notes on the charts. And then here is actually January of 2023. And this was a very important low that almost, for the NASDAQ 100 and the NASDAQ composite, it almost went down and touched this low, but it didn't. And here in the S&P, it was much higher. But I took a count at that time and I said, this looks like it may very well be nearly complete. And I think we had one or two more columns over here. But I took this count in 3 segments. And so the first segment took us back to the resistance zone. And we did, in fact, go above that and then pause again. And the 2 larger counts, look at the count objectives we're revealing. 50.75 to 53.50, 62.75 to 65.50. Yeah. And this is from 37.75 on the S&P. And so, and 4,000 at the point at which I made this chart. So point and figure, and look at how beautifully point and figure gave us downside objectives. So this gives us a sense of perspective. And also it says we built enough cause in this accumulation to give us this much vertical price potential. Mm-hmm. That is so valuable for perspective. Absolutely incredibly valuable. And people at the time thought I was certifiably nuts. Mm-hmm. And they, it's like, this, all we're doing is we're setting up for another decline. The Fed's raising interest rates and we have high inflation, all this stuff. And it's like, I didn't disagree with any of it, except this is what the tail of the tape was telling us. This is what the market was saying it wanted to do. And now here, this is a chart I did in November of 23, but all I did, this is a reaccumulation that occurred 2018 to 2020. Look at it, perfectly hit this objective. And then here's our bear market distribution. And now here's the count. I took the same count I just showed you. And this is the potential, which very much is in alignment with the count we just took all the way back in January of 2023. And you could see now we've just touched 5,000, I think, on the S&P.
Yeah, well, we're above already. But
go ahead.
One question comes to mind. When I want to practice Wyckoff, do I also need to apply always point and figure? Like, is it part of the idea?
Yeah, it was very much a part of Richard D. Wyckoff's methodology, was to use vertical bar charts in combination with point and figure. And so he used those together. But I have many friends that I've known through the years that only use point and figure charts. They don't even look at vertical charts.
All right.
And there's many people that just look at vertical charts.
Yeah.
Wyckoff, the classic Wyckoff methodology approach is to use both. And but I know many people that successfully just use one or the other. Now these are just swing counts. This is one box method. So this is just looking at, this is 2022, and just looking at the swing structure, gave a count. This is a minimum count. This is a maximum count. And it went into this zone. Oh, and then this one, this count here is another reaccumulation count. And it counted up to as high as 430 to 460. And then once this was out and starting to run, and this is actually through February 5th, but here is taking this whole reaccumulation structure, which went back into 2022, by the way, counted up to 465 to 495. And then it gave us a little distributional hinge here, counted down. We got within one box of the low, because this is the objective 415, and went to 410. And then you can see here, though, that this is the highest print I saw a day or two ago, 50284. So we basically have gone to 500. We haven't gone to the 505 box. So we've gone to 500, which is only one box above the high count here. So I'm making the case here that this count very well could be completed. This upward move that we just evaluated on our big accumulation structure for the time being. And do recall, everyone, that this count here went to 5,075 to 5,350. So this is right. This count objective range here is very much where we have just gone to. And so I believe we have, for the time being, used up the fuel of this advance, and that this resistance at the old highs of 4,800 on the S&P could very well come back into play as resistance. And so there's all this excitement, all this bullishness about the market at this time because of how strongly it's trading. But the point and figure counts, at least for the moment, appear to be exhausted. And here is a count through Feb 9, or here's just a line chart of the S&P going over 5,000 here, getting right into our price objective range. And look at the sentiment. This is the CNN Fear and Greed, which anybody can just look up. It's a neat little sentiment indicator. And then this is the historical timeline back a year. So you can see here that we fulfilled our point figure counts. We've come out of our accumulation zone, had a big markup. We've had somewhat of a climactic event in exhaustion into our point figure target zones, and we're getting high levels of bullish sentiment into that reading. So it's kind of a I call it, from my old horse racing days, because I worked, as you'll discover in the prior podcast, I worked in horse racing as a kid. It's a trifecta. That's a trifecta right there.
Yeah, I mean, what people always forget is that every move has an end, reverses, has an end, reverses again, and stuff like that.
Yes.
And I mean, right now, and again, talking about beginning of 2024, everybody's going crazy about this hype, AI, everything is about tech. Fair enough, because it will not disappear. But yeah, maybe,
I, I
you know,
I'm so old, Wieland, that I was around for the .com. I was around for like all those old tech. I was
yeah.
around for the early '80s IPO boom,
Oh,
which which was like the first when the PC, which was basically a doorstop, didn't
mhm.
do the internet or anything. And we had Eagle Computer, and we had Microsoft and IBM, the IBM PC and all that. So I saw them all. And
Yeah.
I can't say I saw them all, but this is AI. Yeah, AI may very well prove to be a very important, but it's the hype around it that we have to be careful of.
Yeah, so and that's a point because you already mentioned some numbers, and it's amazing because you just didn't come up with the numbers today because you came up with the numbers like a little bit earlier where we are with the S&P right now. So like around 5,000, and yeah, with a little bit speed, a little bit momentum, but at the end, every move has its end. And if people they get soaked into the market right now, whew, not good.
And this happened in 21, but markets typically end with climactic surges.
Yeah.
And they have these big accelerations that come at the end. I believe we've seen some element of that. And we
Yeah.
get a climactic surge, and then we have to spend time building cause.
Yeah.
And it's either going to be a cause for a distribution,
Mhm.
and distributions form faster than accumulations.
Mhm.
That Shake Shack example formed over 2 years, but the uh, distribution that formed in 2021 took just a few months. And so distribution can form very, very fast.
Sure.
Uh,
Can be
uh,
V-shaped, done.
yes. Now, there's a special category, and I think this might be in our future. There's a category of a stopping action which has all the characteristics of distribution when it starts, called a reaccumulation.
Mhm.
And so you get a run up and an acceleration into a buying climax and an
Yeah.
automatic reaction. And then you have a range bound condition that can last months and months.
Mhm.
I've seen them last over a year or two.
Mhm.
And they build a cause for a next leg up. This is my favorite structure. And
Yeah.
to learn how to identify and trade a reaccumulation really is powerful, because what it can do is it allows you, if you did not catch that first move, or if you did catch it, but you want it to add to that position because you think it's going to continue to go higher,
Mhm.
you can buy the reaccumulation when it gets into its final testing phases and add or initiate trades in stocks that are very dynamically rising.
Yeah.
So I love the reaccumulation structure.
Yeah. Basically looking at it, it's more because I already thought about, okay, we're talking about a trading range, which is just a sideways move. And basically, it should be a continuation formation and not a reversal formation. I mean, both is possible, obviously, but this looks like a continuation formation, which is more likely to appear.
I, I have one of the things I love to do, and a big thank you to the SeasonX people, seasonax.com,
Mhm.
for allowing me to use their tool, is really fun people, really brilliant. And
Yeah, absolutely.
this is a seasonality that I do every year at the beginning of the year. And what I do is I take the 4-year presidential election cycle back as far as the data will let me, and I just do a seasonality chart for the 4 years for that year. So in this case, we're in a presidential election year.
Mhm.
So this is all the presidential election years going back, as far as we have data, in this case, 49.
Yeah.
And you can see here that what happens is that the market generally goes sideways for the first quarter into, in this case, with a shakeout type event in March. And that could be characterized as a reaccumulation. We may be having a reaccumulation with a shakeout or a spring at the conclusion, and it sets up a more important rally into the second and third quarters. And so I'm very much on the alert. I always have to confirm with my Wyckoff principles, but I'm on the alert for a reaccumulation to form, and sometime in the second quarter, might come later, they don't always come on time, is to have a more important rally phase, trending phase, and that would be a wonderful opportunity for us as investor traders to identify the reaccumulation and participate in this uptrend. So I really like the idea of that reaccumulation structure being what's potentially unfolding in 2024. And then this, you get a correction down into just before the election, the US presidential election, and then strength into the end of the year. And I've been doing this every year, and it's amazing how well this seasonality seems to work and help us to identify what could happen. We always have to confirm it with our tape reading skills. I have one more chart I could show you.
Yes, please.
I think we've gone probably quite a long time, but well, this is the chart I was looking for.
Yeah.
This is a sentiment chart. It's two sentiment charts. This is the American Association of Individual Investors bull bear ratio. So it's the green is the number of bulls in this weekly. It's a weekly question that they ask their members, and the number of bears. This group tends to be quite conservative under the best of conditions. And so when you get a very high reading, and so here you can see at the peak right before the COVID crash, they were quite bullish. And then here in 2021, right into this peak zone here before the distribution, they were the most bullish.
Yeah.
And then they became very, very bearish. They were very bearish in the kickoff of the 2021 rally, and they were very bearish in 21, 22, while the accumulation was forming that we just analyzed. And then look at the bullishness that they have just exhibited. So as among the highest that we've seen back to 2017.
Yeah.
So very bullish group. And then this is the National Association of Active Investment Managers. So these are investment managers that are timing the market, and they will do a survey of them weekly. And when it gets above this dotted line, they're effectively on leverage. And so you can see, and I do a very long-term 13-week moving average of their position. This is what they're actually doing, their exposure. You can see they had very low exposure during the accumulation. And then as the accumulation started to go, they became more involved. They are trend followers, and generally they're good at what they do. I've spoken to that group before. And so no criticism at all. But here you can see they're on leverage into that peak, July peak, and they were in a leverage position at the end of the year 2023. And they still have a very high exposure. So my only point being that sentiment can be a very valuable tool.
Yeah.
And it tells us a lot about where we are. Sentiment's quite low, pessimism is high. You very well could be creating accumulation structure. And when sentiment's quite high, you should be looking for attributes of distribution. And look at this acceleration that we had in the beginning of 2024. Is that you can see this has a climactic quality, and it went right into, this is the S&P, it went right into our count objective range on our point and figure work on two levels, 1 box and a 3 box.
Yeah. Wow.
Now, last thing really is, this is a kind of a fun one. Again, tip of the hat to the seasonax.com people, is this is a 10-year decennial chart. And I only want to put this out kind of as a way for us to conclude our discussion in the regard that I've been using this chart, this decennial pattern for 40 years. And this data is just averaging every year of the decade back to 1897. The series ends at 2015, but I'm going to get it updated. Adding one more year for into the 2023-4 isn't going to change the data much, if at all. Yeah. And so here you can see characteristically that the 0 year to the 2 year is typically where you get a bear market. And this is generally the worst part of the decade. And so the 2 year, in the middle of the 2 year, you get your final low. We actually got our low in 2022 and around October with a deep test at the end of the year. And so you can see that the you can see here the uptrend beginning in 2023, and we had a very good year in 23. And in fact, the best part of the year was in the first half.
Yeah.
So the 3 year generally concludes with a reaccumulation trading range with a decline into the end of the year. Our decline started in July and went down into late October. And then look at the momentum surge that we get into the very early part of the new year.
Yeah.
Does that kind of characterize what's going on right now? Yeah, is absolutely. That we've had this great momentum surge into the 4 year, and that's exactly what we're doing. But we just looked at a seasonality chart for 24, which happens to also be an election year. And so here, note that this looks like a reaccumulation, which we just looked at the schematic for. And if the 4 year, and you know, Wieland, in the US, it looks like this could be a very tumultuous election year. There could be a lot of drama in our election process in 2024. Yeah, I'm not predicting, sure. But I'm suggesting it's possible. And so we have a big surge with a lot of optimism and a climax in the early part of the year. And then we get a reaction down to, it looks like about May, a retest of the peak, and then another pullback into the election. And that constitutes our reaccumulation. But Wieland, look at the 5th year. Does that look like a lot of fun? Does that look like fun to you?
If I'm a buyer, yeah.
Yeah, right, exactly. Well, I'm just suggesting, I'm not saying this is the way it's going to happen, but so far it appears to me, other than the 0 year, which we have to remember was a COVID year, and the Fed was pouring money on the markets and creating lots of liquidity, that we actually had our peak. We had the internal peaks of the market occurred in the first half of the 1 year, with a high in the Mag 7 type momentum stocks into the end of the year.
Yeah.
So it's a little different at the 0 year, but everything that's occurred since so far seems to be playing out. And so if we could get a year 5, the year 2025, to be a trending year, this could be just a glorious good time. And so I'm only suggesting that as a perspective about the possibility of a positive outcome out here, but we need to confirm it with tape reading and with our good chart sense, and we need to see the attributes of reaccumulation. This should produce a big point and figure count. This is a point and figure count. These are both reaccumulations, and then have this big 5th year. So I just put up this accumulation schematic here, which is just a way to be able, and so you can see the family resemblance, selling climax, secondary test, accumulation and reaccumulation structure here and here. And so I'm just putting up maybe a possibility for a Wyckoff type structure that could be in the process of occurring even in the fourth year. And like I said, we always confirm it with our tape reading skills, point figure confirmation, and let the market tell us where it wants to go. So
amazing. Really amazing. I mean, there are so many conclusions about this. First of all, if you want to short in 2024, be quick. Right? So you better take your profits. Same if you buy, take your profits. But if you're short at the end of the year, wow, better get your helmet out.
Exactly. Yes. It just as being short at the end of 2023 was not a great idea.
Yeah.
And here, if we do get a rally into the end of the year, kind of around election time, that takes us up and out, this would constitute a sign of strength, getting above that resistance zone and then having a short, sharp, but shallow backup that stays above the resistance zone. That could be a confirmation or evidence that this scenario could very well be in play. And then we just want to be really good at being good trend followers, and just have, good trend following rules for following the market up. Because when you complete, here's the essence of Wyckoff. To see accumulation form, to recognize how much potential's in that accumulation, with the expectation that there's going to be a markup that follows, and that markup is going to have significant potential and will go up for months to years, depending on the time frame that we're functioning in. And the markup is where Wyckofians are, their purpose is to capture profits in those markups.
Yeah. Nice.
And so there is the essence of what the Wyckoff method is designed to do. And anyway, this is a wish. It's not maybe what's going to happen, but it's kind of a fun idea to think about. And we can make point and figure counts. Don't forget, we actually have a point and figure count of this whole structure that we can see on the seasonality that counts up as high as around 6,350 on the S&P.
Yeah.
So imagine the possibility of that, if that, in fact, that count can be realized.
Yeah, I mean, we can put everything together, because having a method just to measure where should be the best entry point and the time for it, like using seasonalities, using the Wyckoff methodology, and watching the markets unfold with the trend, using trend following strategies as well. Maybe you want to also do some counter move trades. You're good to go. You have a lot of ideas, and just having this kind of analysis gives us some kind of blueprint how to follow. It's like a roadmap.
Yes.
So that's how I would like to understand it. Also, how people should use it. It's not like you have to do this and that now. It's like, okay, this is a roadmap, and let's see how it unfolds, if it really leads us there or not.
Well, and so the beauty of having a roadmap, and today, for instance, so we've been talking about how the market has been marking up, rapidly accelerating. It's been climactic. I've heard a lot of sort of giddiness from market participants about how well the market has been going up. And when I looked at the market before you and I started our talk, it was down. The Dow Jones was down at one point more than 500 points. And so to me, that is characterized by this phenomenon here. So again, we always want to to really understand, in this case, the schematics, we want to understand the character of markets. So when we get an acceleration into a climax, so we get in this case, it's a buying climax, we would expect after a big run up that there'd be a very sharp, sudden, unexpected, outsized move back down. And that could very well be what we're getting now. And if that's in fact the case, we probably have to spend at least some time developing a cause if we're going to go down in for the next few months.
Yeah.
And so now the market is doing its distribution dance. And so it's, I'm suggesting, but what we need to see next is it goes down sharply here, and then it has a short, sharp reversal that gets back towards the old highs here at the buying climax peak, and then it reverses back down again, and now it's doing potentially the distribution dance, or the reaccumulation dance, and we just need time to be able to identify the characteristics. So it's a time to be patient and to really pay attention and let the market tell us where it wants to go.
Yeah, it looks like market participants got quite a hit today, and need to rethink. And this takes time, and this is how this can unfold. Yeah, totally agree. I totally agree. As we already just rallied a lot, and we come to all these areas everybody's watching and looking at, and this is like 5,000 plus. And
one, I do look at indicators. I'm not just a pure tape reading guy, a pure bar chart guy. And this is the NASDAQ stocks. This is the advanced decline line daily. And then what I do is I do a 30-day smooth moving average. And so here, all I'm doing is, and this is the New York Stock Exchange version of that. And so what I would point out here on the comp is that the peak came right at the end of the year. And so I'm very much focused on quarter end effects. And so you see here, the peak came right at the end of the year, but the index itself went higher and higher. But this was all a function of the Mag 7 type growth stocks. And there were others that carried the day. And so they just kept going up and up. But look at what the average stock in the NASDAQ did since the end of the year. It's been persistently falling, and it went below zero here. So now you have, on a 30-day basis, you have more stocks that on balance have been declining than advancing. And so this is to me, this has been a big tell that percentage-wise, the ability to be able to pick stocks that are still going up is getting harder and harder. It's just a probability thing. When you have these on a 30-day basis, stocks are in a downtrend. You have fewer and fewer stocks that can bring you profits from going up. And the Mag 7 carried the day here in January, February. And then that also you can see is the case in the New York Stock Exchange.
If they lose steam, everything drops even further.
Exactly. And it's only a question of time. Often these will peak out at the same time. And so I look for two things. So here's a very important low in March for price and this indicator. And when they're going up together from an oversold condition, I'm looking for candidates to buy. I want to own the best leadership, the best relative strength, momentum stocks off those lows, the ones that are leading the way higher, because they will lead before the lows are in. Same thing happened here in October. And so here's the July peak. And you can see when this starts to turn down, you're selling off your stocks that are losing their relative strength characteristics, and maybe for those that like to short stocks, they're shorting stocks on the as the market goes from overbought to oversold on that 30-day indicator. So
Yeah.
I'm always looking at these kinds of breadth indicators.
Yeah, makes sense. So looks reasonable, and it's funny. I did an analysis today, came to the same conclusion with the Mag 7 exactly like this, as they are, just pushing everything up, but not really. And as they have like 25 or more percent of the whole S&P 500, you better be careful.
Uh, and of course, you can go back to prior periods where that was the case. In the dot-com era, that was all true. There was just a few stocks that had huge market cap. And
Yeah.
you go back to periods like I was around then, but I didn't trade during the Nifty 50 era, but
Mhm.
I was familiar with those companies.
Yeah.
And in the Nifty 50 era, everybody should read about the Nifty 50 era, because the Mag 7 era is very much akin to that.
Yeah.
And you can learn an awful lot about markets by studying those prior periods, because none of this is new. They just change the names.
Yeah. It's always like this. And our job, Bruce, as analysts, is to get on this and really identify these schemes, these ideas, and first of all, warning people about it's one thing, but also get some profits with it as well. So that's what we do.
Perfectly said. Perfectly said.
Wow. Thank you so much, Bruce, for the insights as well,
Oh,
also the teaching, and also for the forecast. And once again, summing it up, there's a lot profit taking waiting for us the next years. So, and
well,
we can look
the
forward to
beauty of the
this.
market is it always gives us opportunities.
Yeah, of course. Well,
Yeah.
we have to find them.
And we have to just continue to listen to the market. The market will tell us where it wants to go. It's
Yeah.
fun to do seasonality. It's fun to do the what ifs and all that. But in the end, you have to let the market, you have to let the tape, as Richard D. Wyckoff told us,
True.
tell us where it intends to go.
Wow.
So,
Yeah. Thank you so much.
oh my gosh.
And now we have two things. We have the mental side, we have the technical side, so it's perfect. And looks like fun being Wyckofian, and looks like very profitable as well. So congratulations to this. And I'm really happy to learn more about this, and I will go deeper into this as well. But first of all, thank you for the start and for all the nice, beautiful, wonderful explanations. Thank you so much.
Well, and also, if anybody, there's lots of free content for people. They go to wyckoffanalytics.com. That's a site run by my teaching partner, Roman. And it's a wonderful site. And there's lots of available content on just the Wyckoff method. And there's some great analysts there. So go check it out. Yeah, I think it's a good place to start.
Yeah, I will link it as well. So